What is going on? Today's video is going to be from a request and a comment section. So again, I do my best to try to do request videos. If you leave it in the comments, again, I will try to add it. If I miss it, then just leave it in the comments section below. Again, I do like to try and it's my way of kind of responding to you, right? Make a video about it if that's what you want. So today's video is a request left in the comment section below. But before we get started, welcome to my channel. I am the Covered Call Guy, and for those who are new, my goal here is to create $120,000 in annual passive income, currently with 7 holdings, more to add in the future. Right now, GPIX, QDIVO, GPIQ, IWMI, SPYH, QQI, and IDVO. These holdings currently yield me about 70 grand a year, 5.8K a month, 1.3K a week, and $193 per day, $8.05 per hour. Okay, legal disclaimer before we start though. This information presented in this video is for informational and entertainment purpose only and should never be construed as financial, legal, or tax or investment advice, because I am not licensed to do any of that. Okay, get your own certified attorney, accountant, financial advisor. Okay, all opinions expressed are strictly my own and do not constitute recommendations to purchase, sell, or hold any securities or financial products. Viewers are strongly encouraged to perform your own due diligence and consult with a qualified professional before making any financial or investment decisions, because if you don't, then you're a dummy. All right, with that out the way, let's get started on today's video. Right, we're going to be dissecting ticker symbol DBMF. What is that? Right, it is a futures strategy ETF. Yes, this will be the first time I'm talking about futures strategy. Now that I thought about it, I should have asked a friend who does nothing but futures. He actually is pretty much country hopping. I think he just finished wrapping up Thailand and Vietnam. Now he's in Japan. He country hops, pretty much just trading futures and making his money off of that. So I should have just hit him up. I should have been like, hey, is my information correct? Now that I think of it. Okay, all right. Hopefully I did get the right information for my own deep dive in this ETF. All right, let's get started. All right, so what exactly is DBMF? So for my due diligence, right, it is an actively managed ETF that attempts to replicate elite hedge funds, right? It does not buy stocks from my understanding. Instead, it uses a highly liquid futures contract to go long and short across global markets. So first view, I would say just think of this kind of similar to options, right? You're betting in the future, but with specific assets, right? Essentially, the main difference I want to say is that futures and options are the same derivative income contract, right? Used for, I want to say, speculation or hedging, depending on, like, you'll put shorts and all that stuff, right? But they, I want to say they differ primarily in obligation and risk, right? Futures are obligate parties to complete a transaction, whereas option buyers, you know, they have the right but not the obligation to act, right? So, you know, like providing capped risk, like the premiums paid, right? So, you know, obligations, right? Future contracts require both buyer and seller to fulfill the contract at expiration, while I want to say the main difference is that us option buyers, so I have the right to act, while sellers, which is the writers, are obligated if the option is exercised. Okay, so that's the main difference here. Okay, again, right here, this ETF goes to capture massive market trends regardless of which way the economy is moving. Okay, so let's look at the tax nightmare that comes with this ETF. So I want to say right now, perhaps you might want to keep this out of your taxable brokerage account unless you do want an absolute nightmare with the IRS. Okay, real hedge funds get a special 60/40 tax break on their trades, right? I think DBMF loses this perk because it uses an offshore Cayman company to trade commodities. Okay, so when those profit comes back to you, the IRS will backhand you with rates up of 37%. Okay, I want to put a disclaimer here. I am not a tax accountant, so please talk it over with a certified one before doing any of this, certifying this information is correct with this ETF. I think this ETF does come with a tax nightmare. I could be wrong. Okay, again, This leads to being handcuffed by the SEC, right? So real offshore hedge funds use a more massive amount of borrowed money to supercharge their return, right? The SEC doesn't let retail ETFs do that. So Rule 18F Tag 4 forces DBMF to put strict speed limits in a way, right? Pretty much handicapping you, handcuffed, and capped it on the risk. So you're basically buying a watered down version of a real hedge fund. It still works perfectly fine, but the protective spikes won't actually be quite as massive during the crash. All right, so let's look at the drawdown lag, okay? This is just using the historical data, right? DBMF does not function like a put option providing instant protection, right? So trends following requires time for a trend to manifest. So that leads to a possible, if an equity crash is a rapid reshape like the one in August, right? The Yemen get in dawn, whatever, with the Japanese yen, right? Or March 2020 with the COVID shock, right? DBMF will fail as a hedge. It participates in the initial drawdown, right? But only adding value if the crisis turn into a grinding bear market. So it has to have the right conditions for that. Okay, so WTF is a futures. For those who are, obviously for not the person that asked, because you probably know what futures are, but for those who don't know what it is, after hearing this, you're probably like, man, why even bother with futures, right? So why do people even bother with futures? Well, imagine agreeing today to buy or sell something like oil, gold, or the S&P 500 at a set price months from now, right? It lets you make a more massive bet on where the world is heading without actually owning the physical stuff. As you can see, the crude oil, that was a lot of futures. People betting it was going to go higher, right? Profits in any direction. I guess this is where the real cheat code here is why people like it, is the flexibility, right? You don't need the stock market to go up to make money. Futures will let you seamlessly short the market, right? If you know bonds are going to crash, and you can bet against them and then profit from pretty much the destruction, right? The crash. Right? Exploiting human panic, okay? So this strategy exploits the behavioral biases of the market. So specifically our human tendency to panic, hurt, and then react slowly to new macroeconomic data, okay? This is what pretty much futures, you're trading futures do, right? By measuring momentum across short, medium, and long-term time horizon, right? You're using algos, right, to establish long positions when the market, when the assets trend up, and short positions when they break, right? Because they seamlessly short asset classes, right? They can short equities during a deflationary recession, or short bonds, go long oil, agriculture, whatever it is, right? This is the whole point of futures. You can kind of be very flexible in what you want to do and how you want to do it, when you want to do it. Okay, copying the smart money. So let's look at this ETF, right? There is no single manager risk, right? So picking one hedge fund is dangerous, right? If you all in your eggs on JP Morgan, Goldman, Neos, right, no matter how well they do, at some point, if they mess up, right, it can go all wrong. So if their specific strategy guesses wrong, right, you do lose big, right? DBMF does somewhat fixes this by copying the top 20 biggest managed future funds in the world all at once. Okay, so DBMF is probably one of the better future ETF out of the whole bunch that, you know, it's available, right? So it's removing the risk of picking a bad manager. Why the strategy? Well, instead of building its own trading strategy from scratch, right, DBMF basically looks at the recent performance of these top 20 funds, and then it uses the math to figure out exactly, you know, what they're buying and selling, and then build a simple portfolio and then just mimics them. It's essentially like that gimmick video I made with the Vista shares, right? They like, oh, invest like Warren Buffett or whatever, whoever else. It's kind of like that. All right, the real advantage, of course, compared with others, it is a pretty standard low fee here of 0.85% flat expense ratio. So if you were to go with an elite hedge fund that charge you anywhere at least 2% of your money, right, just to manage it, plus 20% of your profits, right? So by simply copying the big guys, right, the big dogs here, right, using a cheap, easy to trade contract, right, DBMF pretty much charge a flat 0.85% fee to do that. Okay, pretty much like the Vista share, that kind of, you want to invest like Buffett, well, pay us whatever, you know, fee, instead of actually having to give your money to them, right? So you keeping the extra 20% profit is huge. That's a lot. I mean, you paying 20 cents per dollar, so that's a lot. All right, the competitor landscape, obviously, you know, DBMF pretty much approaches the strategy with a top-down replication, right? The comping, the fee is 0.85, tracks the top 20 CDAs, kills single manager risk, which their peers like KMLM, CTA, WTMF, ASMF, right? They all have quite similar fee, but their key differentiator is that it's pretty much the you want, you know, pair non-correlation stocks, you know, trade only bonds, commodities, broader coverage, occasionally hold Bitcoin, right? Highly responsive, but risk whips or penalty. So if you just want hedge, just want to count all of them, then you kind of lean towards DBMF with a decent expense ratio here. As you can see, it's the highest one. It's a top second highest one, but overall it is kind of similar in a way for copying the top 20 biggest hedge funds. All right, the ultimate crash shield, it does have a negative 0.2 beta during crashes. So this is pretty much, I would say, the beautiful part of this ETF, right? So out of everything I just talked about, this is, I want to say, the better aspect of this, right? So this asset fundamentally does not care what the stock market is doing. And historically, managed futures have zero connection to the stock market, right? When panic hits and everybody's selling, well, DBMF naturally pivots and move against the stock market. That is what the data is showing us. All right, so this shields your portfolio without really having to rely on the naive hope that stocks will always go up. Because again, futures aren't stocks. Futures is its own thing. It's its own beast. All right, so why do you actually buy, right? So if you're this guy right here and you're making a whole bunch of money off futures, this is the part where you go, why do you want this, right? You gotta ask yourself, right? Are you gonna buy it? Yes, this is exactly why you buy it, because you want something called crisis alpha, right? So looking back at 2000 tech crash, right? Stock dropped 46%, but managed futures gained 28%, right? In 2008 financial crisis, stock dropped 55%, managed futures surged 24%, right? So when the stock market goes one way, this goes the other way, right? So when investor panics and sell everything, pretty much DBMF did the opposite, right? Step in and harvest those massive profits. All right, so you can kind of allocate this to your position as a, you know, the ultimate hedge, inflation hedge, right? Instead of holding cash or whatever you want to, you know, have it as a dry powder, you can kind of use this to kind of hedge against your stocks, right? Normal inflation hedges like gold and real estate would have completely failed you in 2002 because interest rate went up way too fast. The opposite, right? Managed futures saw inflation come in, and the algorithms simply bet against the bond market and bought energy. So pretty much done pretty well doing that, right? DMF made a massive 21.5% return that year. That is pretty insane, right? It is one of the only investment that can profit from crashing bonds while riding an oil and gas boom. Has right now still doing pretty well. All right, so fixing your broken bond portfolio if you do hold bonds, right? The trap here is bonds are supposed to protect you, but ever since 2022, it hasn't really done its job, right? But when pretty much explaining here that when inflation hits, central banks rises rates and your bonds crash at the exact same time as your stocks, you pretty much have nowhere to hide. Well, this is the fix here, right? Take 20% of the money you would normally put in bonds, and instead you could put it into DBMF, right? DBMF acts like the insurance as it systematically bet against the bonds when interest rate rises, saving you from a dual crash. So this is the other option here. So good pick for whoever. I totally forgot. I am sorry for not forgetting, for putting you in the slide here. But hey, now this is now open to you guys to play futures. I'm not really a future player investor, I guess, allocator myself. That is something where maybe, but I'm not really I wouldn't really put it into my portfolio now. I might change my mind in the future. I'm not gonna say never, you know. It's never say never, I guess, you know, because things change. So If you were to ask me, oh, would you hold it? Right now, I would say right now, no, but probably in the future, maybe. All right, how do elites use it? How do the big money, the smart money use it? All right, so looking at when the stock market crashes, if you were to look at the data, big university endowments run out of cash, right? So instead of selling their stock at absolute bottom, they use managed fund as the emergency ATM, right? Because DBMF spikes during crisis, right? It generates fresh cash exactly when you need to buy most of the dip. So this is how smart money plays this. All right, so let's look at the all-weather portfolio. Again, this is my if you wanted to kind of play it around with having a little bit of everything with equities, mixed bond, gold, and managed futures. All right, this is if you want a portfolio that would survive any of the 4 economic quadrants, which is rising or falling growth and inflation, right? You would need kind of the Ray Dalio's risk parity, right? DBMF acts as a chameleon asset, right? It kind of changes and it kind of bet against it. You're playing around each other, right? You have the 4 major assets here that you can kind of play here. You really can't, if one goes down, the other goes up, right? So it pretty much smoothing out massive generation drawdowns by seamlessly kind of rotating to fit the current macroeconomic climate, right? You have equities, mixed bond, gold, or silver, or whatever you want to hold, right? So and managed futures. All right. This is the math of the allocation here, okay? If you're conservative, obviously 3 to 5%, right? For income and capital preservation, all right? Source 3 to 5% pro rata from bonds and cash, right? It provides a more marginal tail risk reduction without exposing you to the zero return periods of calm markets. This is where if I were to hold it, I would be the more conservative, right? I would say no more than 5%. 3% sounds good enough for me. If you're someone probably like yourself, you left a comment, you're probably more interested, you would probably be the more moderate size, right? 10 to 15%, right? If you do run a standard 60-40 kind of 60-40 percentage rate, this would be the optimal sweet spot in my opinion to actually move the needle during a severe dislocation. So this is where I want to see actual hedging and movement, right? So I don't want to see that fluctuation, especially with futures. Just not for me, I guess. I'm just saying this now, but perhaps in the future I'll change my mind and be like, hey man, you were right, I should have bought more futures. I don't know, right? So mathematical impact of these obviously is historical back testing, right? I do draw a lot of my information on looking at historical back testing data. And then, of course, drawdown mitigation, right? So integrating a baseline 10% allocation in 2022 would have mitigated a lot of the maximum portfolio drawdown by over 1/5. So now that you have this data, perhaps, I don't know if you bought it yet, but hey, perhaps you're going to buy more and load up on more, right? All right, aggressive macro sizing. So this is if you're pretty aggressive, I would say you might end up with the 50-30-20 portfolio. So if you're if you're the highly aggressive macro allocator, right? So then you would allocate 20 to 25% primarily sourced from fixed income that can fundamentally actually alter your efficient frontier. So this would really move the needle if it swings one way, okay? If the market really end up being volatile, this is where you go, you would see your portfolio really move, right? This is where you're going to put a lot more money into DBMF, right? You would do a little bit more, 50% equities, 30% bonds, and 20% DBMF, right? So, and this is if you're aggressive. Of course, the patient premium, all right? I do want to make this clear because this does require extreme behavioral discipline. You absolutely have to be willing to pay the price of patience premium here. And what I mean by that, you're going to have to endure years of underperformance relative to peer equity indexes during low volatility, low inflation regime. Again, we don't know when it's going to happen, but if it does happen, right, if you capitulate early, you will, again, miss the crisis spikes, and then you just lose out on everything. So it's not worth it. All right, I don't mess with futures, but if I did, this is how I would rank your DBMF ETF. Diversification, I'm going to give it a 5 out of 5 just because zero correlation to stock and bonds over long horizons. So good for you. inflation hedge, I would give it a 5 out of 5. Profits from crashing bonds and rising commodities. Good for you. Crisis protection, I would say, is pretty decent. It's not bad at all. 4 out of 5. I'm judging a lot of this off historical data, of course. Great for long bear markets, but I just want to say here, okay, fails in quick V-shaped recovery crashes. So understand that. That's why I took a point off. Complexity and risk, I'm gonna say at least I'm gonna be honest with you, I was a little bit biased here. I give it a 2 out of 5 because, again, futures is a little bit complex for me, at least a little bit too complex for me. All right, black box model with SEC leverage caps and then the lagging, right? So it doesn't really track extremely well, and to me that's part of the risk here. And again, futures is a little bit too complex for me to understand. If anything, I ask my friend who trade only futures. He only does futures, and it's crazy. He makes like anywhere from $4,000 to $7,000 a month profit. And that's why he's able to country hop, right? So I should have asked him about this video. Tax efficiency, at least from my knowledge, I'm gonna say 1 out of 5. I'm gonna say this one is really brutal on ordinary income taxes. So if you do have an IRA and you're not really needing the income, perhaps keep it in an IRA, right? And then fees is 4 out of 5. Hey, 0.85 is incredibly cheap for actually needing if you wanted to go with an actual hedge fund. So 4 out of 5. If anything, we'll split it even and say 3 out of 5, right? Keep it in the middle. But I give it 4 out of 5. All right, hopefully this was informational, educational, not just for you, but for everybody. Hey, maybe you got interested in futures now instead of, I think you were the first one to mention futures. So, hey, maybe you sparked a lot of people's intriguing, you know, hey, maybe they need to add some futures into the portfolio. So, all right. I do want to end this with this part though, okay? I wasn't going to add this part, but again, DBMF is not your primary growth engine, so don't act like it is, okay, guys? I'm going to get a lot of people, oh, it's not great for the growth. Okay, that's not the whole point of it. It doesn't do growth, right? Again, I don't think it would beat the S&P 500 in a roaring bull market, but yes, it is an incredible holding to hold. Why? Think of it as a portfolio shock absorber, okay? It keeps you, you know, from the bumpy roads, all right? Again, allocate anywhere from 5 to 15%. 5 is the more conservative, like myself, up to 15%, perhaps even more for someone like you who are a bit more aggressive. Or again, keep it in an IRA if you really do care for the taxes. That way you can sleep a little bit more peacefully at night, knowing you are semi-protected from the next massive crash. That's what I'm going to end this video with. Okay, guys, good call on the future ETF. I do like that you gave something pretty unique. I haven't talked about it. So again, I appreciate all of you for leaving the comments and kind of asking me on the next, perhaps take a look at this ETF or this stock or whatever's happening. So I appreciate all you guys, and thank you for watching. Thank you. Stay tuned for the next video. Catch you guys in the next.